last example. This is transfer pricing. It's on the study guide, very last page at the bottom. And it's a discretionary pricing example. It says Bob Company is the parent company and located in the U.S. with a 34% tax rate. It's selling an inventory item, which is an intercompany sale, that cannot be obtained by its subsidiary in another country. So in other words, this other company, its subsidiary in a different country, has no way to purchase this inventory item except from Bob Company. The cost of the inventory to Bob Company is $30,000. Generally, the markup is 20%. However, the transfer pricing allowable to taxing authorities in both countries is a maximum of $50,000. The subsidiary can sell the inventory for $52,000. So that means they go out in their own country and sell this. What should Bob Company do to minimize their tax rate and maximize their after-tax profit? Transfer pricing is something that is really being extensively looked at by countries around the world, especially here in the U.S., because it does cause, I don't want to say problems, but it doesn't really reflect accurately what's going on, and it allows companies to kind of have a way of increasing their after-tax income. So let's look at, in this case, we're going to say Bob sells to their subsidiary at the maximum transfer price that they can, $50,000. So Bob's sales are $50,000. That's what A company's paying for it. Cost of goods sold is $30,000. They told us in the example that Bob Company's cost is $30,000. That means there's a gross profit of $20,000. $50,000 minus $30,000 is $20,000. For this example, we're going to assume there are no other expenses involved, and just to highlight the difference in the income. The income tax rate in the U.S. is 34%. So $20,000 times 34% is $6,800. If you subtract the $6,800 in taxes from the gross profit of $20,000, you get $13,200. Here is A company. They're going to go out and sell it in their country, and they already told us they can sell that inventory for $52,000. The cost of A company for this inventory, remember they paid Bob $50,000. So their cost of goods sold is $50,000. The gross profit is the $52,000 minus $50,000, which is $2,000. That A company's tax rate is 50%. So $2,000 times 50% is $1,000. Their after-tax profit is $1,000. So when we want to look at the combined effect, the after-tax profit, when you're looking at both companies, is the U.S. profit of $13,200 plus the A company profit of $1,000, which would total $14,200. Now let's look at if Bob Company, instead of selling at the maximum they could, at that transfer pricing maximum, if they sold it at what they normally mark it up for, 20%. So if you look at the cost to Bob was $30,000, the markup would be 1.2 itself plus 20%. So if you multiply 30,000 times 1.2, you get 36,000. The other way you could do it is just do 30,000 times 20%, add that to 30,000, and you would end up with 36,000. So here, our sales, now Bob is selling to A company, instead of for what it originally did, $50,000, it's selling to A company for $36,000. Bob's cost of goods sold is $30,000, so its gross profit, sales minus cost of goods sold, is $6,000. If you take $6,000, multiply it by the 34% tax rate, you get $2,040. $2,040 from $6,000 is $3,960. That's their after-tax profit if they sell to A company at only the traditional markup of 20%. Okay, A company is going to still sell theirs in their country, this inventory, for $52,000. Now their cost of goods sold is lower. It's $36,000. Because remember, that's what they paid Bob for this inventory. So the gross profit is the sales minus cost of goods sold. Gross profit is $16,000. Remember, they have a 50% income tax rate. So 16,000 times 50% is $8,000. So our gross profit of 16,000 minus taxes of 8,000 gives a company an 8,000 after tax profit. So if we add Bob's after tax profit of $3,960 and a company's after tax profit of 8,000, it totals 11,960. Let's compare that to selling at the maximum transfer pricing. In that case, because of this tax differences between a company and Bob Company, that after tax profit in total was 14,200. So you can see it's more than a 2,000 increase by selling at the transfer pricing maximum. So that's just something I wanted you all to be aware of. Transfer pricing, as I said, it's really being looked at by countries. It's a way kind of to increase net income when you're not really increasing net income. But companies do this. That it reflects they're going to always do whatever they can for maximum transfer pricing to achieve the lowest result in income taxes and in turn increase their net income. If you have any questions about any of this, please feel free to contact me. I just wanted to show you the information. You don't have to worry about the numbers or, how do I figure this out? I'm really showing this to you just to show you how these things work. The only numbers you have to worry about calculating are the 5 problems for assignment 3. So if you have problems with those or you're confused, please feel free to contact me and I can help you out with those. Thanks. Have a good week.